Okay, let's also tell you about how the telecom space is panning out and what are the concerns that are currently arising. Sachin Gupta, Regional Head, Telecom Research of Nomura, joins in on the show right now. Sachin, hi, morning. Firstly, the performance for Indian telcos was pretty disappointing and highlighted structural issues faced by companies as well. Have you changed your outlook on the sector, and is the derating of the stocks enough for now?
No, we haven't changed our outlook for the sector. We have been pretty bearish in Indian telcos for about 12 to 18 months now. And what we have seen in the past two results now is the competition is still there. It's not as bad as what we saw back in 2010 when the price cuts were 15 to 20%. But we are still in an environment where we are seeing 3 to 4% price declines every quarterly result. So I think given we still have 5 to 6 viable players in the market, that kind of price declines can be expected. The other issue that's happening is the data take-up, which has been relatively low. We've had 3G for the past 2 years now, and even now we're still seeing carriers running at between 3 to 4 million 3G subscribers, and that has limited the potential revenue surprises.
Sanjay, margin compression in the case of Bharti was sharper than expected. If I look at the EBITDA margins for the quarter gone by, margins have contracted by about 400 bips. That's about 4% for the quarter gone by. What is your take on operating profit margins and EBITDA margins for Bharti going forward?
So I think with Bharti, you can break it down to two parts. One, in the domestic business, we saw a pretty sharp decline in margin in the domestic wireless business in 1Q results last week. And that's a function of Bharti actually changing their strategy to some extent to regain revenue market share. And as part of their strategy to win back revenue share, they actually have had to incur higher costs, be that on the SG&A or even on the network cost. So we can expect some sort of uplift in the margins, but I don't think it's going to be significant within the domestic market alone. So around 30 to 32% is probably a reasonable outlook in the near term. The big delta for Bharti will be in the African business. They made this acquisition 2 years ago, and since then we had seen a margin improvement every quarter, but except last week what we saw was they actually had 200 basis point decline in margin. There were some one-offs in there, but looks like the competition or the elasticity argument is not holding to the extent we had all anticipated. But having said that, 25-26% margin in Africa still seems quite low, and that's where the positive surprises are likely to come from. And realistically, that business can easily go up to 30 plus margin in the next 12 to 18 months.
Are valuations at 18 times for Bharti sustainable according to you, and what will make you turn positive on the stock then?
Look, I think valuation is obviously driven by the earnings. For what we have seen for this stock is it's been very hard for the analysts to actually get the earnings forecast right in the past 2 years. Most people have given it the benefit of the doubt, but the numbers have turned out to be weaker than expected. If you look at the earnings revision, there's been about 60 to 70% negative revisions in the past 12 months alone. So stock, 18 times stock, you can argue is actually not a cheap stock at the moment, given we don't have a lot of visibility on the earnings outlook in the near term. And also 18 times it's an expensive stock given the regulatory overhang we have in the domestic market.
Sanjay, now there are some reports that Bharti could be looking at filing for RHP for the tower business. Do you think this will help the Bharti stock?
Look, absolutely. That's something that has been talked about in the last 2 to 3 years now. One of the things Bharti is currently facing challenges on is its high gearing levels. There's currently about $13 billion worth of debt on its balance sheet, and the intention is to deleverage that in the near term. And one of the ways of actually doing that is actually selling some of the assets like the tower businesses. The question remains, however, is that the market conditions are actually not favorable, so they may not be able to optimize the value of this networks or these towers in the current market conditions. And also the underlying performance of the tower businesses has been relatively muted. If you look at metrics like the tenancy ratios, it's still tracking at 1.8 to 1.9 times. That's actually below what the market expectation would have been 2 years ago at around 2 to 2.5 times. So, but in the net, it is still would be a positive catalyst if these guys can get a decent valuation and deleverage their balance sheet.
Right. Sachin, you also have a reduced rating on Idea. What makes you bearish on that one?
Look, Idea, we've had a reduced rating for a while and slightly driven by valuation. The stock at 20 plus times earnings, we just don't think the stock is cheap given the regulatory uncertainty the company is facing or likely to face. We don't dismiss the fact it is a very well-run business. In the past 2 years, if any telco that has consistently gained revenue share has been Idea, and people have been willing to pay a premium for this thing. But in the current environment, we just don't think it's easy to extrapolate the trends we have seen in the past going forward, given the competition is likely to pick up a notch.
Sanjay, government has set an auction reserve price at 14,000 crore. Which companies are at more risk, and what are the risks you see coming from the regulatory side?
So it's basically every company is at risk. There are two things. One is the reserve pricing, which is 140,000 crore, 140 billion rupees. That's just the reserve price. The question becomes is who will likely to bid at these reserve prices? Not a lot of telecom companies actually have the financial capacity at the moment to write checks this big. But what the government's also considering is the possibility of a deferred payment structure, whereby the operators only pay 30% of the amount upfront, then there's a 2-year moratorium, and then the balance over the next 10 years. See, that kind of structure could allow more companies to bid for the options, and given the cash outlay in the initial years could be lower. But net-net is not a positive outcome for any other telecom company, but relatively companies like Bharti should fare better, and Vodafone as well, vis-a-vis some of the newcomers or even the companies like Idea.
Sachin, Arcom, and you maintain a neutral rating on that one, while the company has not clearly been able to reduce its high leverage. You see risks of cash flows coming under pressure in the future?
From an operating standpoint, this company hasn't really surprised in the past 12 months, you could say. The big issue, as you highlighted, is the balance sheet capacity. The current net debt to EBITDA is 5 times. Which is one of the highest amongst the regional telcos. They have made various attempts to deleverage that. They were looking to sell the tower businesses, their submarine cable assets, but there's been limited success to date. So that remains a big challenge for this company. And until that happens, it's very hard to see this stock getting re-rated anytime soon.
Finally, Sanjay, stacking order, rate telco stocks for us: Bharti, Arcom, and then Idea.
Currently, I mean, we don't like any of the Indian telcos, but if you had to pick one, the relative preference would be Bharti, given the diversity of earnings the company has and given its scale. Second would be Idea, then third would be Arcom.
Okay, Sachin, good having you on the show. Appreciate you taking the time out and joining in.